Oof, who's been telling the stock market to bring it on? Boom. Make sure that you're enjoying the process, because I promise you, if you're going to be active in the stock market for the next 10, 20, 30 years, you're going to have so many periods like this. Probably ones that are much, much worse than we can ever even imagine. So folks, enjoy being tested. It's all fun and dandy when everything's going up to say, oh, I'm going to buy the dip. I'm going to buy the dip. I'm going to get a good deal. I'm going to strategically buy Tesla. I'm going to buy Apple. I'm going to buy all these stocks that are now dipping. But then when they start dipping, you're thinking, oh no, what if they dip and they never come back? And that is legitimate emotion. Feel that. Feel that emotion and then make a logical decision anyways. Is that permission to go blindly buy dips? No. Is that permission to do your work on these plays and value them correctly and then make a decision? Yes. But I'm going to be with you putting all of our plays and plays that you ask me on trial, talking about some short-term opportunities and talking about different ways that we can exploit these market conditions. But let's go ahead and go into what happened today. Another huge day with the broader market cooling off. Nothing too surprising. We were talking this weekend about how we weren't going to be out of the storm and how we should be preparing with our inverse ETFs for negative days. Why? Well, because last week bond rates went up, and because that was bound to happen again this week. Well, that's what we saw. This is amongst accelerating vaccine pace news, a strengthening dollar, and overall economic sentiment that the US is going to rebound massively. A massive economic rebound is a threat to the market because people are worried that if it rebounds too quickly, we're going to see out of control inflation, which then the Fed's going to have to go and intervene and raise interest rates, which then overcorrects the market and takes away a lot of the easy money that's going and propping up our markets. However, the Fed themselves are saying that interest rate increases are not on their way right now. But yet investors aren't believing the Fed and bond rates keep increasing. But this isn't exactly a new trend. In fact, the 10-year treasuries have been rising since the beginning of August. It's actually a good thing because that means the economy is rebounding. People are expecting things to get back to normal. We're getting back to that benchmark. The problem is really this is increasing too quickly, and that's scaring investors. They're thinking that the Fed's going to have to step in and intervene. They're thinking the worst case scenario is going to happen and they're going to have to come in and overcorrect. However, if you look at the context of the last 40 years, increases in bond yields have been short-lived and the overall trend has been a clear downward direction. So in terms of ways that the Fed can step in and say, hey, we don't want this to happen. We don't want market turmoil. We don't want a lot of these sectors to cool off. Well, what the Fed can do to keep interest rates low, not just their official interest rates, but also bond yields, something called Operation Twist, where they sell front-end treasuries and buy longer dated ones. The effect of that would stabilize the long-term rates, which is what everyone's worried about, and also potentially create some level of a floor from which a lot of these sectors can bounce back off of. Why would the Fed do this? Well, because at the current rate, the bond market is getting out of their control, and with that, they're losing control over the stability of the stock market. Now, in the past, of course, the Fed has stepped in to stabilize the markets, and they could do that again to stabilize and create sort of a floor for stocks to bounce back on so that we can all enjoy the recovery. But of course, as traders, it doesn't really matter what the Fed does or what the market does. We have a clear plan, and we're ready to strategically exploit. So I want to talk about some of our biggest plays, some of the ones that I see as very, very good holds through this volatility, as well as some short-term opportunities and recaps. And the only thing that I ask in return is that you hit that ravishing like button, and also don't forget to subscribe. Okay, so first recap, Mara, lovely Mara. Mara held up pretty damn well today. That's as Bitcoin broke back into the 50s, and it actually defended itself pretty well against the overall market crash in equities. Obviously, Bitcoin itself isn't the stock, but we have seen some correlation between Bitcoin and the overall market in the last couple of weeks. But on the flip side, I think that in the long term, you're going to see a break of that correlation. And that's a good thing. I'd like to see Bitcoin as a little bit more of a hedge against the falling market. So far, that hasn't been the case, but any day that moves more towards that is a great thing. And if that happens, you're going to see a disconnect between Mara and Bitcoin. And if Mara goes down while Bitcoin goes up, that's a great opportunity. Why? Well, because if Bitcoin is going up, that means Mara, a Bitcoin miner, is going to be more profitable. So if you're paying less for Mara while Bitcoin is going up, that means that you're paying less per unit of profit for Mara. Our more speculative SOS play actually held up pretty nicely today. This one popped up 20%, but folks, make sure that this is a short-term trade. I'm not a huge believer in the business model of SOS. This is a short-term speculative trade. You get in, you get out, you trade fluctuations. One of the only wins that I'm proud of today in the overall Red Sea was KMP8. This was an FDA approval play that we've been preparing for weeks. We've had this on our briefing since mid-February in anticipation of their March 2nd approval. Actually, you don't have to be a member to get the FDA approval date. You can just Google FDA approval dates and do the research. I do that for you in ZipTrader U, but this is one of those things, if you put in a couple hours of work per day, you could go and do it. But of course, the point of showing this is not so much to say, hey, we didn't have a Red Sea today. But overall, there are a lot of short-term battles that you can take on as well if you're looking for catalysts and you're mapping them out ahead of time. And that's what happened with this play. And it did double, so pretty good play overall. In terms of short-term plays, SQQQ and UVXY were huge today. We talked about this in our top stocks video from Sunday. Make sure that you think inverse ETFs when it comes to down days, especially if you're seeing that interest rate pick up on that day. Okay, folks, now it's time that we talk about our these will double stocks. These are ones that, despite a rocky condition, option, I think are very good prices right now. The first one you already know is PLTR. My price target on this one is $55. I'm extremely bullish on them. They have strong clients. That includes governmental institutions and many Fortune 500 companies. The next one, or ones I should say, are iPod and iPof. These are two SPACs and both will be choosing a merger partner soon, and both are led by Papa Pauly. He's led many other successful SPACs that have doubled in price, and even if they don't double in price, these are still pretty damn good deals. I'm looking forward to seeing what merger partners they choose, but these are going to be very exciting plays. But with these, you have to look bigger picture. The whole thing with these is the merger partner. Because of their leadership team and the track record of said leadership team, these are likely going to have great companies to merge with. The other one that I want to talk to you about is CCL. So I issued an official price target at $50 for this one today. It's trading at 28 bucks right now, but when we first talked about it, it was trading back at $12. And back then I set certain criteria for what would need to happen with this play in order for me to be excited about it as a longer term recovery play. And as a result of different levels of vaccination amongst different countries and different ports that cruises go, I was worried that, hey, maybe this is going to take a lot longer than the other travel sectors to recover. And I still stand by that. But the thing is that we're seeing a lot of these travel stocks factor in 2-3 years in advance, and CCL hasn't really factored it in to the same extent that a lot of the other cruise lines have, nor to the same extent that a lot of the other travel sectors and stocks have. So prices, if you're looking for a slow play to ride out the volatility, I still think this is a good play. I want to talk about HOL. This is of course an SPAC that is merging with Astra, and the current price means they've wiped away most of their premium that was given to HOL after the merger talk. Okay, the other one that I want to talk about is Jumia. So Jumia is, of course, our African Amazon play. They've reported great numbers. They're doing better than ever. But of course, because of the overall innovative tech sell-off, you're seeing these prices get pretty damn cheap. This is a good deal, and I would hold this through a lot of volatility. In terms of airline stocks, I see AAL as one of my favorites because it has the most to gain by this pandemic ending. Of course, all of the airlines have a lot to gain, but AAL has a lot more deprecating factors holding it down if it doesn't. And that's why it's trading at a cheaper price than all of its competitors. So I continue to see AAL as one of our good recovery plays. Anyways, folks, in the last video, I asked you guys to do some diligence on Vuzi, but I got so many questions on Clove instead. So we're going to just talk about Clove instead, and in the next video, we're going to talk about Vuzi, because there's a lot I want to talk about Vuzi. In terms of some of our plays that performed bad, Clove was probably the worst second behind Workhorse. 3 deprecating factors going for it right now. Number 1, it was already in a sell-off because it was an SPAC merger play. SPACs have this thing where they run up on hype, and then when the merger goes through, they go and get beat down. So it had that, and then it got hit by a short seller report that I think is mostly unfounded, and nothing has changed my opinion in that. And now it's getting hit with the overall tech sell-off. Originally, my thought process on Clove was that the short seller report would be something that's really bad for the stock for about 2 to 3 months, and then it would start rebounding again. But then the tech sell-off hit, and it did pretty well in the beginning, and then it ended up getting worse. This is one of the plays that I believe in, but I do see a long time horizon for this. In the beginning, I thought it was going to be a couple months, but now you're looking at it and you're like, hey, well, the overall tech market's cooling off too. So perhaps if the tech market rebounds a little bit faster, it could be a little bit faster of a recovery for some of the share price. Usually when we have a little bit murky waters in terms of the market, people want me to downgrade some plays, but I only downgrade plays where their value has actually changed. Value isn't dictated by market psychology. I mean, it is in the short term, but in the long term, it converges to its real value. Of course, with a play like this where you have investigations and you have a big short seller against it, there's always some risk that you're taking. For me, I still see the risk versus reward favorable, but for you, you have to compare it to your other plays and your overall account. If you're taking risks on a ton of health insurance companies, that's not going to be the right move. If you take a risk on a few strategically placed healthcare companies that you believe in, then even if a couple don't work, if more work than not, then it's not a problem. With Clove, we're in a big storm. I think it's going to make it out very well. We just have to get to the other side of the storm, so I'm not going to downgrade it. Of course, that's my opinion. You can make your own opinion, but anyways, folks, that caps off the video. If you have any questions, if you'd like to join ZipTrader Circle, you can go ahead and click the link to ZipTrader Circle below. And of course, a lot of people always ask me, Charlie, what broker should we trade these stocks on? And I always like to tell them Webull. Webull is a great platform. They offer pre-market and after-hours trading. A lot of the biggest moves like CCIV, Workhorse, all of that good stuff. A lot of those big moves happened in the pre-market and the after-hours. So if you didn't have a broker that allows you to trade during that period, well, you'd be Scrooged. I'll put the link below, but they are a great platform, and I think they're worth checking out. And if you'd like to learn how to trade, would like access to our private chat and daily morning briefings, as well as our price target updates when we do update our price targets, well, I will go ahead and put the link to ZipTrader below. You can learn all about it on the website, see if it's a good fit or not. Take some time to think about it. We want to make sure that you're a good fit and you feel confident and ready to put in the work. So anyways, folks, have a great day, and I'll see you in the next video.